Hi, everyone. So, welcome to the live stream today. Really excited for having you on the stream today as we continue with our masterclass discussions for the November 2025 examination. Over the last few weeks, we've been sharing our thoughts on solving practical questions on key areas in financial reporting, corporate reporting for the most part. And today's discussion is going to be special because we are centering around management accounting to deal with a crucial 20 marks area in management accounting that you need to know about, and that is what we want to get ourselves into. And so we're going to be solving a question on management accounting. I see some of you guys joining. You are welcome. Give us a thumbs up on the video. It helps us a lot. And also share the video so we can reach as many students as possible. Remember that the registration for the examination is still ongoing. So if you are planning to sit for the November 2025 examination, then you know that the exam registration is still ongoing and will be coming to an end next month, middle of next month. So you are still in a comfortable lead to make your assessment and make your decision whether you are going to sit for the examination. As I say always, it is important you understand that you are going to be preparing for only the papers that you think you're going to sit for, and most importantly, you're going to pass. Right? So you want to be measured on the way you structure yourself out so that you can prepare well for the examination and most importantly, pass the exam. Remember that you can also get access to our content, our premium content in the Nhyira Premium mobile application or on our website, and enroll to study under my mentorship with a team here as we guide you so you prepare well for the examination. So you can still register to join our class. You get access to the lecture videos, get a mentorship session, join our live stream sessions, and also be held accountable, let me put it that way, and join our live lectures, pretty important, so you'll be guided better to pass the examination. So we are still in the process for the November 2025 examination, and you can definitely register to join the stream. Let me hear from you. If there are any questions you have, you can put it in the comment section or the chat for me, and I'll be excited to answer any questions that you may be having. So let me bring up my screen quickly and let's get excited into the discussion today. Now, we still have copies of our books available that you can get access to. And so if you are looking for any of our books, we have copies available. You can send us a message on WhatsApp on the number on the right down or the right corner of the screen. Send us a message on WhatsApp and you'll be able to get access to our books, and wherever you are, delivery will be done. We have books on public sector, financial reporting, advanced audit and assurance, strategic case study, corporate reporting, volume 1 and volume 2, because of how much material is available there. So it is broken into volume 1 and volume 2. We have taxation also available and can be used for principles of taxation as well as advanced taxation. We've done the segregation, so it's a 2-in-1 book for you there. Then we have our management accounting book that you can get access to as well. Then certainly financial management book. So all these books are available and you can get access to them. Call us on WhatsApp or call us or send us a WhatsApp message and you'll be guided on how you can get copies of these materials to help you to position yourself to pass the examination. Now, let's get into the discussion today. And as I mentioned, we are focusing on management accounting. And I'm going to the question 1 of management accounting, which is always going to be on performance management. Okay, performance management, or in some cases called performance measurement. So performance measurement or performance management. So this is question 1 area, 20 marks waiting for us in the exam hall. That will be coming whether I like it or not in the management accounting examination. So today we want to look at that, and we are looking at a question from the ICAG July 2025 management accounting. So it's an ICAG past question, July 2025 management accounting. And we are focusing on question 1 because that is where performance measurement is, for 20 marks for us to see what we can do. As you can see, pretty simple question. We don't have a lot of things to do here. but the requirements will require us to really do a lot of things. So for 20 marks, the requirement of the question is simple. It says, as the management accountant of Oliso, prepare a report to the manager of the group in relation to the following issues. So you are preparing a report to the manager of the group in relation to the following issues. The best performing territories. The best performing territory in terms of A, return on investment, ROI, residual income, RI, economic value added, EVA, and D, calculates the percentage change in revenue, total cost, net asset during the period that will be required for the central territory to achieve a target ROI, return on investment, of 20%. So these are the requirements in respect of this particular question and what we are expected to do here. So let's go back up and read the story. The Oliso Group, Oliso, operates a chain of hospitality units in the country grouped into South, Central, and Northern territories. Operations in each territory offer similar services and face similar operating environments and risks. The operations in the group are categorized into accommodation, restaurants, and bar, and other services. The table below presents a summary of the financial data of Oliso for the year ended 31st December 2023. So let's get goosebumps and begin the discussion. Oliso Group. So the A part of the question said return on investment, ROI. So return on investment, ROI. Now, if you remember, the formula for return on investment is going to be the operating profit, or if you want, controllable profit for that division, divided by the capital employed, and or in some cases, total asset. So operating profit, or if you want, controllable profit. The reason we are interested in controllable profit is because in the concept of divisionalization, sometimes there will be apportionment of overhead expenses, and so of the head office. And so what happens is that the head office exists to serve those divisions. And so at the end of the period, the head office cost will be apportioned between the various divisions. But those costs are not within the control of the divisional heads. And so for divisional performance measurement, usually it is inappropriate to use the actual profit of the division, inclusive of the apportioned division head office overheads, in analyzing them. And so that is why we will be interested in controllable profit, which relates to the actual profit that each division earned, excluding allocated overheads from the head office. And so controllable profit divided by, in some cases, total assets, depending on the context of the question, but usually it could be total assets or capital employed, which is the regular customer. Now, I'm in class, so I need to give you the generics so that if you see it in a question somewhere, you don't run off. So it could be operating profit or controllable profit divided by total asset or capital employed. In some questions, the examiner will say, hey, I want you to use total assets. In some questions, the examiner will say it should be capital employed. In the context of our question here, we don't know what's happening, but let's continue to read. Maybe we will get some images. So for starters, we see the operating profits respectively, which we are going to be working with, which is the same as profit before interest and tax. Then we can see their statement of financial position. Let's look at the additional information because that may give us guidelines on how certain workflows to be done. So let's go. I. The policy of OLISO is to define residual income for each territory as operating profit less the group's required rate of return of 75% of each territory's total assets. And so when it comes to RI, which is residual income, it's going to be on the operating profit minus 17.5% of the total asset of each of the divisions. Pretty important there. So it means the concept here is not necessarily on capital employed, but it is on total assets. Note 2. The long-term loan is centrally managed and not split among the territories. Good news, because it's centrally managed, so the head office. Income tax is charged at 22%. This is going to be coming in the C aspect of the question, EVA, and we're going to get into that in a moment. Next, IV. The market value of equity is 11,700, whilst the cost of equity is 20%. Again, we will come back to that because that will be in the economic value added, EVA. V is the book value of long-term borrowings approximates the market value. Again, those will be worked for in the EVA. One of the things that I keep on telling you throughout the series is that you must know which portion of the story is applicable to which part of the requirement. That's very important. So you realize that note 3, note 4, note 5 are all relating to EVA, which is the C aspect of the question. Principles. Let's continue. Note VI. The ROI generated by the central territory is of significant concern for the managers of OLISO, and they are exploring the possibility of achieving an ROI of 20% by considering available options. Okay, that note there could be connecting us to the D aspect of the question, the target ROI of 20%. So that note VI is connecting us to the D aspect of the question, and we'll come back to that in a moment. So we are done reading. Let's get goosebumps and begin to do our work. So A, return on investment for each of the territories, okay? So Southern Territory first. So Southern ROI. Let's get their profits. 514.8. 514.80 divided by, now here, we can use capital employed or we can use total asset for the discussion. Because if you check, for instance, we are told that the RI is on total assets, not necessarily on capital employed, right? So you can use you can use total assets or you can use capital employed. Let's go with the default method because, ROI is the same as ROSI. So we'll be interested in profit before interest and tax divided by capital employed. So we'll do total assets less current liabilities. So total assets is 2340. 2340 minus current liabilities of 104. Times 100. So we punch that out. Let's see what we got. 514.8, 2340 minus 104. And I'm getting 23% approximately. Next one. We're going to dance the same way. We are dealing with a central territory. So ROI for the central territory. Operating profit is 573.3. So 573.30. We divide that by the total asset. What we got? Total asset is 4420 minus the total liabilities, current liabilities. You got to be careful there. And that is 312 times 100. We punch that out there. Let's see what we got. 573.3 divided by 4420 minus 312 times 100. I'm getting approximately, that will be 14%. We are working to the nearest whole number. Then the last one is going to be the northern sector or northern territory. Same idea for the northern territory. 913.9. Let me even stop writing these currencies so that I can go straight up. So 913.9 divided by total asset is 5590 minus the current liabilities 624 times 100. So we punch that out. 913.9 5590624, and that gives us 18%. It's like 18.4% there. So that is the A part of the question, return on investment for each territory. Remember, in the context of this question, we are supposed to prepare a report. So this will come, the report will come in respect of when we finish the calculation. So we'll come back to that. So that is the A aspect of the question and how we deal with this. So I'm seeing some comments coming up. Let's see if I can address that real quick. Okay, so give me a sec. Let's see if I can have a better. Yep, that's better. Firefox said, thank you so much. Okay. Stanley said, why did we use the asset minus liability? Because we mentioned that, let me bring back my short. We mentioned that, yes, it could be operating expenses over total assets, or the operating profit over total assets, or operating profit divided by total capital employed. Now, if you look at the concept of return on investment, the default calculation is controllable profit divided by capital employed. That is the default calculation for ROI. So that is why we are using the capital employed. Nonetheless, if you use total assets, the examiner could still mark you in that case because of the fact that if you check here, they said, oh, the RI, residual income, is on total assets, not on capital employed. So if you use the alternative approach also, that may be considered by the examiner there. That is the rationale behind the usage of the total asset and not the capital employed and not the total asset in our workflow. So that's the issue about that. That's why we are using that. And that's from Stanley Ajaylu. Okay. Let me know if that is clearer for you there. So let's go to the B part of the question. In B, we are using residual income. So residual income, which is RI, right, is going to be still our operating profit minus the notional interest. So operating profit minus notional interest. The concept of residual income is how much money will be left to each division, right? So whilst the Rosie is looking at the returns on the capital employed by the division, The residual income is how much will be left of the division's profit after they pay providers of finance the amounts they are supposed to pay them. But divisions technically don't pay out any distributions. And so that is why it is referred to as notional interest. It's not necessarily that they are going to pay, but we are assuming if they were paying, how much of their profit will be left. And generally, the interpretation of this, we expect this to be greater, to be higher, because it means that the division has a lot available after the payment of those. So let's bring the idea up one after the other. There we go. So first, Southern Territory. RI for residual income. So operating profit for the Southern Territory, 514.8. There. 514,800 minus the notional interest that is what the examiner has given us in the note 1. He says it should be 17.5% of each territory's total asset. 17.5% of each territory's total asset. And so we go to do 17.5% of the Southern's total asset, which is 2340. So 2,340,000. And that will give us the RI of the Southern Territory. So I'm going to punch it all in one. 514 is 514,800 minus into bracket 0.175 times 2340,123 bracket close, and I'm getting 105,300. So that is the residual income for the Southern Territory. Let's do the same idea, but this time around for the Central Territory. 573,300 minus 17.5 of the total asset of the Central Territory, 4,420,000. So we punch that out to give us the residual income for the Southern Territory. So 573,300 minus into bracket 0.175 times 4420, 123, bracket close, and that is giving me 200,200. But it is negative. Okay, it is negative. Got to be careful. It is negative. So it means the Central Division, they didn't make enough profits to pay off the notional interest. So that is going to be negative. Very important. So they are not making enough profit to pay providers of finance. Next one. RI for the Northern Territory. The Northern Territory made a profit of 913,900, 913,900, 17.5 of the total asset of the Northern, 5,590,000. So we punch that out. 913,900 minus into bracket 0.175 times 5590 EO 64,350. 64,350, and that is also negative. So they are also not earning enough to pay providers of finance. So negative. That is the B part of the question, residual income. So from this two, now if you check the ROI, return on investment, yes, you see the Southern sector is making 23, which is above the target of the group, which is 20%, right? And so on that basis, the southern sector may be regarded as profitable. The central and the northern, they are below the 20% threshold. If we come to the RI, how much of their profit will be left after they pay return on their capital, you realize that central and northern are all in the negative, with central being in the worst position of all, but southern is at least having a positive of 105,300,000 Ghana cedi. That is the second idea, residual income. Now, the reason why I am trying to interpret these to you, although it is not required in the context of this question practically, is because in some cases, the examiner will ask you to calculate these, then use it to analyze the performance of each of the divisions, or each of the divisions, or in this case, each of the territories. And so that is why it is important you understand not just the calculation, because in management accounting, we are not just crunching numbers. Our numbers will be used by management to make decisions. And so when we finish crunching the numbers, we must interpret what the numbers means to management, so then management can make the decision whether they should proceed, keep a division, shut it down, or something else. That is the idea about the B aspect of the question, residual income. Okay. Any questions about that? You drop it in the chat or the comment section, and I'm going to read that for you. Next one is my personal favorite area, and that is EVA, economic value added. EVA, economic value added. I want you to stay with me carefully here. It's pretty simple, but quite interesting. Pretty simple, but quite interesting. Now, the concept of EVA is simply going to look at the actual economic value that has been added to the company for the year ended under review. And so in that case, EVA, economic value added, is going to be the net operating profit after tax minus the capital employed multiplied by the weighted average cost of capital, because the entity or the divisions are financed both with debt and with equity finance. This is the formula, NOPA, net operating profit after tax, minus the cost of capital, which is your capital employed times the weighted average cost of capital. So let's see what we got. If we check the idea here, we are seeing their profits coming up respectively, which we used a moment ago, and we'll come back to that. But then we need to calculate the cost of capital, what is on the left-hand side. So stay with me carefully, because we're going to be working one after the other to build everything into the system generally. So stay with me carefully. So first, let's work for what is on the far right side, the weighted average cost of capital first. Weighted average cost of capital, WACC. That's what the WACC stands for. And so WACC, if you remember in your financial management class, is going to be VE over VE plus VD times KE plus KD over VE plus VD times KD. That's the formula. Where KE is the cost of equity. Okay? KD is the cost of debt after tax, if there is tax in the question. VD is the value, market value of debt. Okay. VE is the market value of equity. That's what these represent respectively. So stay with me. Let's look at them one after the other quickly. Some of the things were given in the question, so I want to pay attention to that quickly. For instance, we have the market value of equity here, 11,700. So that is VE, sorry. 11,700. Stay with me. Next, we have cost of equity to be 20%. That is KE, 20%. Next, we are told that the book value of the long-term borrowing, which is the debt, is approximates the market value. So if you see long-term debt is 2340, we're going to bring it up. And so VD 2350. That means that VE plus VD will be equal to 11,700 plus 2350. Let me get a one-liner answer coming up. 11,700 plus 2350. And that is 14,050. Sorry, 14,050. 14,050. Then we move on to the next part. What else were we given? That's all. But now we need one more thing, the KD, cost of debt. That is not given. So how do we find it? Simple. KD equals I1 minus T all over PO, where I is the interest, the annual interest on the loan note, T is the tax rate, PO is the market value of the debt. So some financial management here, right? But you're in the management accounting class. So let's go. What is the interest on the debt? That was calculated here. Stay with me. Finance costs, 234. So we're going to have 234 into brackets, 1 minus, what is the tax rate? We're giving the tax rate to be 22% of profit. So 22%, so that'll be 0.22. Okay, 0.22. Divided by the market value of the debt, which was given to us to be 2350. Certainly the answer times 100 because KD is in percentages. So that's how we calculate the cost of debt. And there is tax in the question, so it will be KD after tax. So we punch that out. 234 into bracket 1 minus 0.22, bracket close, 2350. Ooh. I'm getting 7.8% approximately. So if you pay attention closely, now we have all that is needed to calculate the weighted average number of equity shares. Yep. So now let's calculate the WACC. Nhyira, so all of these things, how many minutes, how many marks? I have told you, forget about the marks because nobody cares about your opinions about the marks. Understand the rule and go away. 11,700 divided by VE plus VD is 14,050 times KE, 20%, okay, plus VD is 2250. Is it 22 or 23? 23 rather. 2350 divided by 14 and 50 times the cost of debt after tax, which we calculated, 7.8%. So we punch this out, and this gives us the weighted average cost of capital. Again, the reason we are calculating the weighted average cost of capital is because the entity is financed both with equity and debt. So you cannot use just cost of equity. You cannot just use cost of debt, the combined, and that is the weighted average cost of equity. So let's punch that out. If you have a good calculator, you punch all in one. 1,700 over 14 and 50, multiply by 0.2, close the bracket, plus another bracket open, fraction, 2350 divided by 14 and 15, 14 and 50 times 0.078, bracket close, boom. Relax. Looks like I'm making an error somewhere. 0.078, yeah, that's true. I'm making an error somewhere. Times 100. So that is 17.95%. Approximately, we can take that to 18%. Easy peasy. So that is how we calculate the weighted average number of equity shares. Stay with me. So we are still on the C aspect of that question, which is 6 marks, right? And we just calculated the weighted average cost of capital. Now, we know the capital employed already of each of the divisions. Then we can bring in the issue in respect of the net operating profit after tax. So let's go. There is a way I want to present to make it quite logical. So permit me to present this way. Let's see if I could, because I want to make sure it appears quite logical to you, so there is no ambiguity. So I'm going to slash in my currency sign this way, okay? Then we'll bring in the capital employed. If you remember, we used that in the A aspect of the question, these figures, 2340 minus 104 for Southern Division, because capital employed is total assets minus current liabilities. So 2340 minus 104, that is 22. So 2236. The Central Division is 4420 minus 312. That is 4108. The Northern Division, we are doing 5590 minus 624, and that is 4966. Right? So these are the capital employed respectively. Why am I interested in that? Because I need the notional returns, right? That is the capital employed times the cost of capital. So I now bring the weighted average cost of capital, which will be 18% throughout. So you are multiplying, and that will give you the notional interest, which we are going to be bringing, or the imputing returns or imputed returns. So 2236 times 18%, 18. That is 402. If we are working 3 zeros up, 402. 4108 times 0.18. That'll be 739. 4966 times 0.18. Maybe that'll be 894 approximately. So that is our right side of the EVA formula. The right side of the EVA formula. So first, we calculate the weighted average cost of capital. Once you have the weighted average cost of capital, we can now calculate the notional interest. Now, I could have avoided some of the workings and punch it directly in the flow and go away. But because I'm in class and I'm looking at this question, I want to present it in a way so you flow. So in another question that we're going to be solving, I wouldn't have to do it 1-1 like this. We can just punch it straight up and go away. But I want to show you this because when we go to the next question, then we wouldn't do this particular workings you are seeing here. But now we have this. So let's deal with our EVA now. So economic value added. Also, Nhyira, all of this for 6 marks. Hey, I see. Yeah, all of this for 6 marks. What do you want? What do you want? You want how many marks? So that's why speed and accuracy is crucial in management accounting. So let's bring in their profits respectively as we worked with earlier. So profit. Let's go. 514.8. Then next one, 573.3. Next one, 913.9. 913.9. Is it 0.9? Yup. 0.90. Okay. Remember what we are looking for in our EVA formula. Net operating profit after tax. So we're going to less the tax. We were given a tax rate to be 22% of profit, if you remember. So at 22%. So we're going to punch these out respectively to subtract it. So 514.8. Nhyira, is it 514 or 541? 514, okay. So 514.8 by 0.22. That is 113. Yeah. Maybe we can do 113.30 approximately. Then 0.22 by 573.3. That would be 126.13 approximately. Next, 0.22 by 913.90, 201.06. So we take these out respectively, and that is what gives us the net operating profit after tax. Okay, no part. 514.8 minus 113.3, 401.50. There we go. 0.50. Next one. 573.3 minus 126.13. Ooh, that's 447.17. Then the last one, 913.9 minus 201.06. Ooh, that is 712.84. So that's our no part. Now we can less the notional interest which we worked for above there respectively, and that is what gives us everlasting EVA. So, boom, like this. So, the notional interest, let me just say above. So you less this, and this is the answer to the question EVA. So I have the last one minus 894, and that is 181.16 negative 447.17 minus 739. 29183. All of the indicators are not in favor of the central and the northern division. Because if we look at the actual economic value of the activities during the year for northern and central, it's still negative. Now let's look at southern. Southern is going to have a loss as well, but their loss is going to be just a little bit. Just a little bit, 0.5. Just a little bit there. This is the answer to the C part of the question. Quite a lot of work. So realize that the A part 6 marks, easy peasy. B part 6 marks, easy cheesy. But the C part, which is also 6 marks, there's a lot of work to do. And that's the balance sometimes, right? So there are some of the questions, it's straightforward. You don't need a miracle. Boom, you go. But other questions, you will need some miracles because you need to work a little bit before you come to getting the answer that you need to get in respect of the question. That is the idea about the A, B, and C aspect of this question. Return on investment, residual income, economic value added. Very sweet, simple, straight to the point. Then the D part of the question, which appears to just be 2 marks, but I bet you the workload involved there, it's not a 2 marks work. I can guarantee you on that. It says, calculate the percentage change in revenue, total cost, and net asset during the period that would be required for the Central Territory to achieve a target ROI of 20%. Stay with me. Stay with me. And so we go to the D part of the question. D. So they want to make a target return on investment of 20%. If we go back up, their current total assets is 4420. So what should be their target operating profit? So stay with me carefully because we are focusing on the Central Territory. Because we are working with some reversal approach concepts. So if the target ROI is 20%, then the question we need to ask ourselves is, should be the operating profit? Stay with me carefully. So you know that ROI is the profit divided by the total asset. As per the context of this question, they are dealing with assets. And so if I want the profit, we make the profit the subject. So the target operating profit will then be the target ROI, ROI, multiplied by the total assets. And so if we check, it's going to be 20% times the assets of the division, which is 4420. And so 20% of that, and that is 884,000. Stay with me. So if they want to make a ROI of 20%, then the total operating profit has to be 884. The question we then have to ask ourselves is, what is the profit they are currently making? It is 573. So what will be the increase in the operating profits to achieve that ROI? So increase in operating profit will be this new profit that they must make for the target minus the original profits that they made, 573,300. And so that gives us what? That is 310,700. Stay with me carefully. So that is slide number 1, that operating profit that they must make. Now, if the target profit is 20% of ROI, and we've seen that coming up here as 884, the question then is, what should be their revenue? So you have to be careful here as a management accounting student. If I want a certain target profit, and I need to know the revenue I need to get that profit, what should I do? So you then have to go back to your break-even analysis concept. Revenue for target profit. So here we go. So let's look at the revenue for the target profit. From your break-even class, you know revenue to achieve target profit is going to be your operating profit in this concept plus the target profit divided by contribution to sales ratio. Yes, in your break-even, you are thinking about fixed cost plus target profit divided by contribution to sales ratio. We know. But here, the concept available is to use the issue in respect of the target profit. Oh, no. Sorry. Stay with me. Fixed cost plus target profit. Sorry. We have to still stay with this. I must stay with this. HR ratio. Because the target profit is the 884, so I don't need operating profit again. So let's go. What is our fixed cost? Go back to the question, because you see fixed cost for the central here. 1419.6. So 1419,600 plus the target profit, which is what we calculated, 884,000, divided by contribution to sales ratio. You know how to calculate that, so I'm not going to do a miracle here. It is contribution divided by sales times 100. So for the central division, our CS ratio will be the contribution 1992.9 divided by the sales of 2730 times 100. Sounds good? So, because this is your contribution, 1992.9 divided by sales. So 1992.9 divided by 2730 times 100. That's going to be 73%. So our contribution to sales ratio is 73%. So what should the revenue be for us to achieve the target profit of 884? So 1419,600 minus 884,000 divided by 0.73. our revenue must be 733,699 Ghana cedi. So 700 and no, I did minus. Sorry. It's plus. Nhyira, gotta be careful. Okay, so 315,000. No, not 315. 3,155,616 approximately. So this is the revenue to achieve the target profit. But remember the context of the question, right? The examiner said we should calculate percentage changes in first revenue. So now that we have the revenue for the target profit, we have to look at their original revenue and find out the percentage change that will be required. So, percentage change in revenue will be final minus initial over initial. So 3,155,616 minus initial, the original rev, 2,730,000 divided by 2,730,000 times 100. So final minus initial over initial. So we punch that out, 3,155,616 minus 273,123 divided by 2,730,123. And so there is a percentage increase of maybe 16% or 15.6%. That is it. This is the first part of the 15.6 Nhyira. That is the first part of the answer to the C part of the question. Percentage increase in revenue. So let's go to the second item, which is total cost. So percentage change in total cost. So what is the current total cost? We know the current total cost already here. We can calculate it, the fixed cost plus variable cost, no problem. But we need to find out what the cost has to be under the new environment based on the target profit. So our target profit will be the revenue we need to have minus the total cost we need to incur. Stay with me carefully. You know the target profit, we calculated that a moment ago, 884,000 equals the revenue we need to have, the revenue of the entity, which is 2730, and that will give us a total cost. So it means our total cost will be 2730 minus 884, and that is 18,46,000 for the total cost. Stay with me, let me see. Let's get the old total cost. Current total cost rather. The current total cost is the variable cost of 737,100 plus the fixed cost of 1,419,600 1,419,600. So we add it up, and that gives us the current total cost. 737,100, 1,419,600, and that is 2,156,700. 2,156,700. Okay. Wait, hold up. It's like, no, this should be the required revenue we need to make for this target profit. Give me a sec. Let me bring this up quickly. Sitting. Oh, God. All right, Ate. Okay. So let's go. So our current total cost is 2,156,700. But then our new total cost 186,000, right? So what it means is that our total cost must decrease by how much? So percentage decrease in total cost. Give me a sec. I'm missing something that I need to get right. Revenue. Because, no, give me a sec. Let me see. I'm missing something. This target profit thing has to work with the required target revenue we are getting here instead, because that's the new environment we are in. So I cannot use the old revenue item. So give me a sec. Let me build that in for the new environment that we are going into, so that $155,616 minus 884 because, give me a sec, let me see. If I'm looking, just give me a sec, okay, let me just confirm something. So our target profit 6 is 5, okay, like this. So 884,000. Our revenue is currently 2750. So our total cost has to be this. So 2730 minus 884, 1846. Okay. So that should be our total cost. So total cost decrease will be, let me not deal with currency, 2156.7 minus 1846 over 2156.7 times 100. So our total cost take it out again, 2156.7 minus 1846 over 2156.7 times 100, 14.4%. So our total cost must go down by 14.4% for the target profits to be achieved. Then the last thing is the net assets. What should the net asset be to achieve that ROI? So, net asset. Remember again that your ROI equals profit divided by your asset, your net asset, which is the same as capital employed, right? So if I'm looking for the net asset, or if you want capital employed, you do change of subject, so it becomes the profit divided by the ROI. So our target profit is 884,000 divided by the ROI of 20%. So the capital employed has to be 884 divided by 0.2, and that is 4,420,000. So in order for the entity to make that target returns of 20%, their capital employed has to be 4,420,000, or the net asset should be 4,420. And so what is the percentage change? And the capital employed has to go up. So percentage increase in net asset will be this new one, 4,420, minus the previous capital employed. You know we used it somewhere here. And we are working for the central territory, 4108. So that's what I need. Divided by 4,420 times 100. So more or less like just a slight change in the capital employed. Give me a sec. Did I pick the right figure? Yeah, 4108. Just a slight change in the capital employed. Just a slight change. So 4420 minus 4108 over 4420 times 100. So that's like 7.10%. So the net asset of the entity must increase by 7.12 or 7.1%. This is the D aspect of the question for 2 marks. It doesn't look like it should be 2 marks, right? Because look at the workflow we've done here, and then the total cost workflow, and then the net asset workflow here for it as well. Now, as I mentioned, the impulse of this question is for us to prepare a report to the manager of the group in relation to the following issues. The best performing territory in terms of So really, per the structure of this question, when you are done, you are supposed to now write the report to the manager of the group. Okay? From whom? You are the management accountant here. Because that's the spirit of the question. What is the subject that it should be writing on? They said best performing territories in terms of, so we can say maybe performance measurement of the territories. So performance measurement of the territories. Then date. It could be today's date or the day on which you are writing the exam, 24th September 2025. Okay, then your introduction will come. And then you go to the body and then you do the analysis for that. So based on the spirit of this question, it says prepare a report. After these calculations, Now you need to structure the report and tell us about the best performing organization and that. So what it means then is that these workings become an appendix to the report that you are going to be writing, explaining the performance of the best territory. And we have done that already, that from the ROI, ROI, and then, ROI, RI, and EVA, it is the Southern Territory that's the best performing territory. Because on the ROI perspective, it has the highest. On the RI perspective, it was the only one with a positive. The EVA, even in the EVA, it was negative, but its negative was smaller than the other divisions. So that could be considered as the best performing territory. Then certainly the changes that the Central Territory is supposed to have in that case. This is what you are supposed to do for this question for 20 marks. 20 marks. So really, if you check in management accounting, speed and accuracy has to be your friend to succeed, technically. So slide 1 there for you, the A part of the question. Slide 2, the B part of the question, residual income, RI. Slide 3, the C part of the question, the first one. The next slide, still on the C part of the question. And then the D part of the question, where we are focusing on the Central Territory and finding out how much their profit has to go up, their revenue has to go up, their total assets has to go up. Their revenue, their their net assets, and their total cost must go up to achieve the target profit of 20%. That is what you must understand in respect of this question. Next slide. And then the net assets difference, workflow. And then certainly the fact that I said we are supposed to prepare a report. So in the context of this question, after all these calculations, you are to prepare a report. Or you have to now write the report and briefly do the analysis of the best performing division. That is the idea about this question. So technically, when it comes to this, there are 3 things you must understand in the question 1 area. The performance of the whole division, number 1. The performance of the whole organization, number 1. The performance of each division, number 2. And then number 3 is the concept of transfer pricing. So in any examination diet, one of these will be there, and you have to be in the position to be able to understand them and know how to write out the answer in respect of that. So that's it about that. Thanks for joining us, and thank you for being part of the discussion today. God willing, Friday, we will continue with the discussion and take something else, possibly still in management accounting, depending on how we can go as we continue with the discussion. So enjoy the rest of your week, and I'll see you on Friday, same time, 16:30 GMT or 4:30 p.m. Ghana time. Bye-bye.